Welcome back to our reading on understanding the income statement. So what we're now going to have a look at is the financial reporting treatment, and we're asked to describe the financial reporting treatment of certain items. And the first one we encounter is an unusual or infrequent item. So either this is unusual, i.e. it's not common for the company, or it's a very rare transaction, but it is not both. It's not unusual and infrequent. Now, our first line says it's reported pre-tax before net income from continuing operations, above the line. In other words, we're going to see this, when we say above the line, we mean above the tax line. So the tax expense is known as the line. This is going to report above it. Now, what that means, because we're reporting above it, we're going to report the figure gross, and any tax relating to these items are going to be included in the tax expense. So it's recorded pre-tax. Okay, again, I think what you need to concentrate on here is what items are included in unusual or infrequent. So notice we're talking about gains and losses from the disposal of business segments or assets. So for example, if we sell some of our plant, property and equipment and we generate a gain or loss, if that is material, we're going to separately report it in unusual or infrequent items. The gain or loss when we sell an investment in a subsidiary, so when we sell the equity in a group company. Provisions for environmental remediation. This scenario is where maybe you've polluted the environment and you know you're going to be having to rectify the situation and it's going to cost money in the future. So we're creating a provision, an estimate of the future expense of putting the environment right. Impairments. We've mentioned these briefly before and we'll mention them again in a later reading. This essentially is when the fair value of an asset, PP&E or an intangible, where the fair value is declined below the carrying value. Remember, when we use that phrase carrying value, we simply mean balance sheet value. So we've got impairments of our long-lived assets or write-offs. Write-offs and write-downs. This normally means inventory. Again, the rule of inventory is it needs to be carried at the lower of cost or market value. So if market value declines below cost, we've got a write-down. If market value declines to zero, we've got to write off and we need to eliminate the inventory from our balance sheet and put it into the income statement as an expense. Restructuring provisions as well, where we're reorganizing the company, those would be included here, and also integration expenses for recently acquired businesses. So you've gone out, you've acquired a subsidiary, but you know there's going to be reorganization, consolidation of various functions, and that's going to incur expense. Okay, those are our unusual or infrequent items. Discontinued operations we're now looking at. Operations that the management has decided to dispose of but has not yet done so or did so in the current year after it generated a profit or loss. Okay, so these are the operating results of entities that we've either decided to get rid of or got rid of partway through the year. So be aware, when we actually sell maybe the equity in a division, the gain or loss on the transaction is an unusual or infrequent item. The entity's operating results up until the date of disposal, that is included here in discontinued operations. So we're talking about the revenues it generated, the expenses it incurred up until the point of termination. Now notice it's reported net of taxes after net income from continuing operations, i.e. it's below the line. Now remember, we mentioned this line being the tax line. So you're going to see these items after the tax expense in the income statement. And because they're after the tax expense, they're reported net. In other words, the tax implications of them is not included in the tax expense. It's netted directly against the item in this line in the income statement. Extraordinary items. Now notice we're saying US GAAP here. Essentially these do not exist under IFRS. So this is only US GAAP. Notice we're defining these as unusual and infrequent, again reported below the tax line, and therefore we're going to report them net of tax. Any tax effect is netted against the line rather than shown in the tax expense in the accounts. Now again, US GAAP actually describes some of these. Losses from the expropriation of assets. Scenario here is you've got an overseas asset maybe, and that overseas asset has been taken from you by an overseas government. Now, if you no longer have control of that asset, it's not going to lead to future economic inflows of benefit. In other words, it's not going to meet the criteria of an asset. So we need to remove the asset from our balance sheet and put it into the income statement as a loss. and that's an expropriation of an asset. Also, we've got in here the gains and losses from early debt retirement, i.e. if you buy back your bonds prior to their maturity dates. Now again, you might get a gain or a loss. You'll get a gain if you can buy the bond back below the carrying value of the liability, and you'll get a loss if you have to pay more than the carrying value of the liability when you buy it back. Now again, for deemed to be an extraordinary item, it would need to be both unusual and infrequent, i.e. a very, very rare event for the company to retire its bonds early. If the company retires bonds fairly frequently before their maturity dates, then it's much more likely to be an unusual or infrequent item. So a little bit of judgment is required there. We also talk about uninsured losses from natural disasters, and they actually classify the natural disasters as earthquakes, tornadoes, etc. Now again, I don't think you need the actual classifications other than knowing uninsured losses from natural disasters. Notice as well, as we said, prohibited under IFRS, so you're simply not going to see these under IFRS. So, brief little summary of these: unusual or infrequent, reported above the tax line, therefore reported gross, and any tax effects in the tax expense for the company. Our discontinued operations and our extraordinary items reported below the tax line and therefore reported net. Accounting changes. So we're looking at two types of accounting changes here. First of all, a change of accounting principle. Now, when we change our accounting principle, and we've got an example here, changing from LIFO to FIFO, this is inventory valuation, and we'll see that a little bit later if you're unfamiliar with these terms. LIFO stands for last in, first out, and FIFO stands to first in, first out. If we change our accounting principle, then notice retrospective application. In other words, not only do we have to apply the policy this year, we have to go to prior years' income statements and pretend that the accounting policy was in effect in those years as well. In other words, we need to restate prior years for the change in the accounting principle. Change in accounting estimate. Now, if we change an accounting estimate, the key point is we need to disclose that change in the footnotes, but we do not need to go back and restate. So the key point to take away from this: if you change an accounting estimate, you do not have to go back and restate prior years. In other words, it's forward-looking, but not backward-looking, compared to the accounting principle, where not only do we apply the new principle going forward, but we need to retrospectively apply it to prior data as well. So we've got an example here. If you change the estimated useful life of a depreciable asset. Now, of course, if you change that, it will affect your depreciation going forward. All you need to do, state, notice it is disclosed in the footnotes, so we are going to need to disclose it in the footnotes, but we do not restate prior years. Okay, so very important that you pick up on that. And it means it's very important to review the footnotes to pick up on changes in accounting estimates, the only place you'll potentially see them. Prior period adjustments. Now, these are going to be fairly rare in practice, but this is essentially where we're correcting errors that we've made in previous years. In other words, essentially we found an error in a prior year, we only spotted it now, and we want to correct for it, or we have to correct for it. So we've got an example here, correcting from an inappropriate accounting method to one that's acceptable under US GAAP. Now notice it's a bit like changes in accounting principle. We do need to go back to the period in which the error was made and correct that year as well. And the disclosure, not only do we disclose what the error was, but we need to explain how it affected net income in that period. Now we turn our attention to non-operating items. Now really what we're talking about is interest, dividends and gains and losses on disposal. Now, are these going to be treated as operating, or are they going to be treated as non-operating? Reality is, it rather depends on the type of the organisation. So, if you're looking at a financial service company, then interest, dividends and gains and losses on asset disposals are part of the core day-to-day business operations of that entity, in which case we'll treat it as an operating item. If you're looking at non-financial service companies, then receiving interest, receiving dividends, making gains and losses on asset disposals, investment disposals, is not part of your day-to-day business operations. It's an unusual activity for the company. It's not part of the core trading activities, and as a result, it would be deemed to be a non-operating income. So when you're looking at investments in terms of interest received, dividends received, gains and losses on investment disposal, whether it's operating or non-operating depends on the nature of the firm that you're looking at. Is it part of its key business operations? If the answer is yes, then it's operating, and if the answer is no, it's a non-operating item. Now our next learning outcome starts to look at earnings per share. We're asked to describe the calculation of EPS and also calculate EPS, and we have to distinguish between dilutive and anti-dilutive securities. So here's our basic earnings per share calculation. We're going to take net income and we're going to subtract preferred dividends. This is because we want the profit that is attributable to the common stockholders. Now we're subtracting the preferred dividends because preference dividends must be paid before you can distribute a dividend to your common stockholders. So net income minus preferred dividends gives us the earnings available to your common stockholders. Now it could be distributed by way of a dividend, it could be reinvested in the company. It's rather irrelevant because it belongs to your common stockholders irrespective. And we're going to put that over the weighted average number of common stock in the year. Now if the number of shares in the company has not changed, that will simply be the year-end number of shares. But if we've got new issues, we've got buybacks and even bonus issues, then the calculation will become a little bit more calculated. So let's have a look at our treatment of stock dividends and stock splits. First of all, what is a stock dividend? It's giving away free shares rather than paying out a cash dividend. So notice a 10% stock dividend would simply increase the number of shares by 10%. So for every 10 shares that an investor holds, they would receive 1 additional share. We've also got a 2-for-1 stock split, slightly different. Now notice a 2-for-1 stock split increases the number of shares outstanding by 100%. So what we're saying is you now have 2 shares. So this is the new position. You did have 1 share. That is the old position. Now you've got to be a bit careful, especially if you're European studying the CFA. The notation with the US is slightly different with what we would use in Europe. So a 2-for-1 is you now have 2 shares, you did have 1 share. In Europe, we'd often write that as a 1-for-1, 1 new share for every 1 existing share, okay? But they say you now have 2, you did have 1. So just be careful with that. So a 2-for-1 stock split is increasing the number of shares you hold by 100%. Now in calculating the weighted average number of shares outstanding, stock dividends and stock splits are applied retroactively, okay, to the beginning of the year. So we're actually going to pretend that the stock split or stock dividend occurred at the start of the year. And in fact, we actually go back to the prior year as well, and we adjust that for the stock split, the stock dividend, as if it had occurred in the prior year as well. Stock dividends, stock splits, we're creating free shares. If you increase the number of shares without raising any new cash, automatically EPS is going to fall. So if we didn't go back and restate prior years, it would cause our EPS to drop. And we want to avoid that, so we restate prior years as if the stock split or stock dividend had occurred in that year as well. Now the stock dividend or stock split is going to affect any shares in issue prior to the date of the stock split or stock dividend. Now, when we calculate weighted averages, in practice you use number of days. Okay, now of course that then gives us problems in the exam. What about leap years? How many days in February, etc. So that's unlikely to be the case in the exam. We won't see days. Instead, it's likely that we'll see months in the exam to eliminate that problem. So let's actually have a look at a numerical example and make sure we can calculate. So notice on the 1st of January X3, we've got 10,000 shares outstanding. Then on the 1st of April X3, we've issued 4,000 shares. Then on the 1st of July X3, there's a 10% stock dividend. Then finally, on the 1st of September X3, we've repurchased 3,000 shares. Now, this stock dividend, what shares could it have affected? It would have affected the shares outstanding at the beginning of the year. It's going to affect the shares issued during the year before the 1st of July, but it cannot affect these shares we purchased. Why? Because that transaction took place after the stock dividend. So we're only going to adjust any shares prior to the date of the stock dividend. Okay, so what we're going to do is take our 10,000 shares, and we've got a 10% stock dividend, so we're just going to increase them by 10%. So that gives us 11,000. So that's our 10,000 times 1.1. The shares issued on the 1st of April, the 4,000 shares, they're going to increase by 10%. So rather than 4,000, we're going to have 4,400. The shares repurchased, of course, no adjustment for those at all. So that's going to remain at 3,000. So shares issued after the date of the stock dividend, shares repurchased after the date of the stock dividend, do not adjust those. They can't have been affected because those transactions occurred after the date. Okay, so the first step, we've adjusted those shares. Right, okay, so now we need to calculate the weighted average number of shares outstanding having dealt with the stock split. So we can take our 11,000 shares and multiply by 12, giving us 132,000. The 4,400, remember they were issued on the 1st of April, so that's 9 months of the year they're in issue for. So let's multiply by 9, 39,600. And then finally the 3,000 shares repurchased at the beginning of September. So we've got September, October, November and December, 4 months remaining, so 3,000 times 4, giving us 12. Now notice that's put in a bracket indicating it's a negative number. Because it's a buyback, it's going to reduce the number of shares in issue. Now we just need to total those. So 132 plus 39.6 less 12, giving us 159,600. Finally then, we just need to take that number and divide by 12, the number of months in a year, to get our weighted average. Now there is a slightly different approach that we can use for this that'll get us to the same number, and just be a little bit aware of this. You might want to do this approach. So the shares in issue at the beginning of the year, the 11,000, we can say, well look, they're in issue for 12/12ths of the year, so that's 11,000. The buyback, the 4,400, they were in issue for 9/12ths of the year. So that's 3,300. And then, so those are the shares issued, sorry, and the share buyback, the 3,000, that was for 4/12ths of the year. So that gives us 1,000. And if we add this up, then hopefully we will get the same answer. So 11,000 plus 3,300 minus 1,000, and you can see you get 13,300. So you might want to take that approach. Exactly the same, no big issue which one you choose for the exam. Either way, you're going to end up with 13,300 as your weighted average. Right, now we need to be aware of dilutive versus anti-dilutive securities. Now what is a dilutive security or a potentially dilutive security? Potentially dilutive securities are any securities that can be converted into new stock in the company. So the ones that we're going to see are stock options. Now be careful, these are not traded stock options on a derivatives exchange. These are really employee stock options. The issue being, if an employee exercises their options, the company creates new shares. Options that are traded on an exchange, if those are exercised, we don't create new shares in the company. So it's employee stock options, warrants. Warrants very much like a call option on the company. Only difference is when they're exercised, the company needs to create new shares in itself. Convertible debt. So this is a bond that can be converted into equity at a future date. And convertible preferred stock. So preference shares or preferred stock that can be converted into common stock at a future date. Now these are known as potentially dilutive. They could be dilutive, they could be anti-dilutive. A dilutive security will cause EPS to decrease if it is exercised. In other words, if it's converted into common stock. whereas an anti-dilutive security would cause EPS to rise if it's converted into common stock. Key point is when we're doing a diluted EPS calculation, and companies with potentially dilutive securities must report at the end of their income statement both basic EPS and dilutive EPS. So when we're calculating dilutive EPS, we will ignore anti-dilutive securities. Okay, so look, a simple capital structure, as we mentioned, they've got no potentially dilutive securities, so no securities that can be converted into new common stock, in which case a listed firm will only need to report its basic EPS. If we have a complex capital structure, we've got potentially dilutive securities, then we need to report both basic and diluted earnings per share. So let's have a look at diluted earnings per share. It looks quite complicated, this, but we are going to break it down into individual components in a second. Now notice this element here and this element here is just our basic EPS calculation from before. Net income minus preferred dividends, giving us the profit attributable to common stockholders, and weighted average number of shares, weighting if there's been any issues and buybacks essentially during the year. Okay, now, what about if we have any convertible preferred stock? So shares that can be converted into common stock. Now, in that situation, if we deem them to be dilutive, and we'll talk about the trick of spotting dilutive versus anti-dilutive in a minute. If they're deemed to be dilutive, what we're going to do is we're going to add back the preferred dividend. Why? Because essentially, if they are converted, we'll no longer have to pay that dividend. So we save the preferred dividend. But so there we go, we're saving the preferred dividend. That's now available to distribute to common stockholders. But, of course, there are now more common stock in issuance. So we increase the numerator by the saved dividend. We increase the denominator by the number of shares created on conversion. If we've got a convertible bond, if that bond is converted into equity, there is two elements to this. Number one, we save the coupon if it's converted into equity. But the second point is we would lose any tax savings. Now remember, coupons are going to affect your tax expense. They're going to reduce your tax expense because interest is tax deductible. So if we pretend that this bond is converted, we're going to lose that tax deductibility. So notice what we've got here is the convertible debt interest, i.e. the coupon on the convertible bond, times 1 minus T, where T is the company's effective tax rate. Argument is, therefore, what we're looking at is the saved coupon minus the lost tax saving, the net, if you like. Now, of course, on the bottom, we're going to increase the number of shares in issue by the number of shares created when the debt is converted. Now, our final convertible or potentially dilutive securities are the employee stock options and warrants. Notice these have no impact on your numerator, but potentially have an impact on the denominator. And we'll look at those separately in just a second. So checking for dilution. We need to check each potentially dilutive security individually to make sure it is not anti-dilutive. Notice only those securities that would reduce EPS below basic EPS. So we're going to need to make a comparison to basic EPS. Okay, so only those that would cause it to fall below basic EPS are going to be included, and we must view them one at a time. So essentially the calculation, if we're looking at convertible preferred stock, what we do is we look at the dividends saved over the number of new shares. In other words, the impact on the numerator, the dividends saved, the impact on the denominator, the number of new shares created. Now, if that is lower than basic EPS, then we've got a dilutive security. If it is greater than basic EPS, then it's anti-dilutive. Convertible preferred stock, again, same implication here. We look at impact on numerator and denominator. So on our numerator, we saved the coupon, but we lost the tax shield. So we look at the net coupon or net interest, interest times 1 minus the company's tax rate, divided by the new number of shares. But the rule's the same. If this figure is lower than basic EPS, then essentially it's dilutive. And if the figure is greater than basic EPS, it's anti-dilutive. Final one is our options and warrants. Different method here to work out whether it's dilutive or not. What we need to do is compare the average stock price during the year, and it's always the average. Why? Because that's what the accounting standard says. So the examiner often will give you beginning stock price, ending stock price, average stock price to try and confuse you. It's average that we need to use. If the average price is greater than the strike price, the exercise price in the option, then essentially it's dilutive because you would like to exercise. So imagine that the average price essentially is $10 during the year, but the exercise price is only $8. Ask yourself the question, would you like to pay $8 for something that's worth on average $10 during the year? If the answer is yes, and of course the answer is yes because I'd make a $2 profit here, then it's going to be dilutive. So in the scenario, maybe rather than having an exercise price of $8, let's say we had $12. Do you want to pay $10 for some? Do you want to pay $12 for something worth $10? Answer no, in which case it would be anti-dilutive. Okay, so let's have a look then at some examples. Let's start off with our convertible preference shares, convertible preferred stock. So we've got earnings available to common stockholders in the year of $4 million here. Our common stock is 2 million shares outstanding, and we've got a basic EPS therefore of $2. That's simply the 4 million earnings attributable to common stockholders divided by the 2 million shares. So basic EPS is $2. Okay, we've been told here that we've got $5 million of 7% convertible preferred stock. 7%, of course, here is our coupon rate. And it's outstanding all year. The terms of the conversion are that for every $10 nominal value of preferred stock can be converted into 1.1 common shares. And we're going to calculate fully diluted EPS. Now the thing to note here is, look, the preferred stock is outstanding all year. In other words, it's not converted in the year that we're looking at. Now, whether it's converted in the year we're looking at or not is irrelevant. What we're doing in these calculations is making an assumption, or let's pretend, if you like, what if they were converted in this year? Whether the instrument can be converted this year or not. What we're trying to say is, if they were converted in the future, how would that affect EPS now? Okay. Right, let's have a go at doing this then. So first things first, we need to look at the preference dividend that we've now saved. And that's going to be 350,000 here. Okay, how did we arrive at that 350,000? Not too bad. It's just our par value, our 5 million preference shares, and the coupon rate on those, remember, is 7%. So that gives us our coupon saved, the preference dividend essentially saved. I say coupon, you can say preference dividend. Theoretically, preference shares are equity, so it's a dividend. However, of course, they typically have a lot of features of bonds, fixed dividends, rather like fixed payments. So often you refer to them as a coupon rather than a dividend. Okay, so 5 million here, times 7%, and that gives us our 350,000. So that's going to increase the numerator of our calculation by 350,000 to 4.35 million. We've then got to consider the impact on the numerator. Now, sorry, the denominator. Now, the impact on the denominator was for every $10 nominal value, 1.1 new common stock would be created. So take the par value of your preferred stock, the 5 million, divide it by 10, multiply by 1.1, and we can see therefore that 550,000 shares are going to be created. Okay, so we've now got the adjusted denominator, 2,550,000. Now the next thing we need to do is to quick check for our dilution. We need to look at the impact on the numerator over the impact on the denominator and compare it to our basic EPS of $2. Well, the impact on the numerator, of course, was 350,000. Impact on the denominator, 550,000. So, of course, you can see that that's going to be way lower than 2. So 350 over 550. What does that give us? It actually gives us a value of 0.64 with a little bit of rounding. clearly way below $2. Therefore, this is a dilutive security. Now that means once we decide it's dilutive security, we're going to add the dividends saved to our numerator to get 4.35 million, and we're going to add the number of shares created to our denominator to get 2.55 million, and you can get your diluted EPS of 171. Now, a lot of people will say at this stage in class, hang on a second, 171 is lower than the basic EPS of $2. So what was the point of doing this calculation and checking for dilution? Well, of course, in the exam, you might have more than one potentially diluted security. And in that case, you need to check each one in isolation to make sure you don't accidentally include an anti-dilutive security. If you just jump to the end calculation of diluted EPS, the danger is you'll include one security maybe that was anti-dilutive, and even though your answer is lower than basic EPS, it's still the wrong answer. So you do need to check in isolation when there's more than one potentially dilutive security in an exam question. Right, let's have a look at our convertible bonds. Treatment, very, very similar to our preference shares. Only difference is that tax savings, because here we're looking at coupons rather than dividends, and of course interest saves you tax in your tax returns. So here we've got profits available to our common stockholders, $2.5 million, 1 million common shares in issue, basic EPS 2.5 million divided by 1 million, $2.50. We've been given a tax rate here of 30% for this company. So we've got 2 million par value 5% convertible bonds outstanding all year. So again, whether the bond can be converted this year or not is irrelevant. We still do a kind of let's pretend it was converted calculation. Each $1,000 par value convertible bond can be converted into 120 common shares. So let's have a look at the impact on this. Now, of course, we're going to save ourselves our coupon here, and our coupon 5% of 2 million. So 2 million times 5%. So we're going to save ourselves 100,000, but if we've got 100,000 less interest in the income statement, then our profit before tax will be $100,000 higher, and therefore we will pay more tax. So we're going to lose the tax shield of $30,000. So actually, therefore, the overall impact of this bond being converted isn't 100,000, it's actually only 70,000 due to the loss of that tax shield. Okay, so if we adjust our numerator for that, we end up with 2,570,000. Now let's have a look at the impact on the denominator. So we had 2 million par value of a bond, and the terms were for each $1,000 par value, 120 shares will be created. So take your 2 million, divide by 1,000 times 120, and we get 240,000 new shares. So the adjusted denominator would be 1.24 million. Now again, both these figures, of course, are currently assuming that the security is dilutive. We better go and check that. So to check for dilution, impact on numerator over impact on denominator. So we're going to put our 70,000 over the number of new shares created. So 70,000 over 240,000. Well, you can see that that is clearly less than 250. In fact, when we do that, we get 0.29. Way below 250. It is a dilutive security, and therefore we're going to include the impact on the numerator, so the extra extra 70,000, I should say, and the impact on the numerator, the extra 240,000 shares to get $2.07. Okay, so notice the convertible bond is virtually the same as convertible preference shares, convertible preferred stock, with the exception of that tax saving or that tax shield on your numerator. Now, when we come to look at employee stock options and warrants, treatment is very, very different. No impact on the numerator of our calculation, but potentially an impact on the denominator. Now remember, it's dilutive if essentially the option, if the employee stock option or warrant would be exercised this year. And it would be exercised, of course, essentially if the average price during the year is greater than the strike price. Whether it can be exercised or not in this year is totally irrelevant. Again, it's, if you like, a let's pretend exercise here. So we're going to use the treasury stock method for this. What we're going to first do is calculate the number of shares created if the options are exercised. And basic assumption here is 1 share created for every option, unless the examiner tells you differently in the exam. Step 2 is we then work out the cash received from exercise. In other words, the number of options exercised times the strike price, the exercise price. Now step 3 is then completely theoretical. What we then do is we pretend that we take this cash from step 2 and we use it to buy back shares at the average price during the year. Okay, we can then calculate the increase in common shares outstanding by taking the number of shares issued in part 1 less the number of shares we can buy back in part 3. Okay, let's do it with some numbers. So our earnings available to common stockholders during the year, 1.2 million. The weighted average number of shares in issue during the year, 500,000. We've got an average price of common stock during the year of $20 and an exercise price on our employee stock options of $15. Number of options outstanding during the year, 100,000. Now our first check is it dilutive or not? Now remember, look at the average price, $20, and compare it to the strike price, 15. Again, if you're unfamiliar with derivatives and you feel a bit awkward, just say to yourself, would I like to pay $15 for something worth $20? And if the answer is yes, it's dilutive, and we're going to pretend that that option is exercised. So this is clearly a dilutive security. Now our basic EPS in this question, of course, is 240, 1.2 million divided by 500,000. So let's run through the steps. We're going to assume that all of the options are exercised, they're all in the money, and therefore one option equals 1 share. We're going to get 100,000 shares. What we're then going to do is work out the cash raised. So take that 100,000 and multiply by the exercise price of $15. 100,000 times $15 gives us 1.5 million. Step 3, totally theoretical or hypothetical. Take that 1.5 million and use it to buy back shares at the average price during the year. And note, when we do that, 1.5 million divided by the average price during the year means we could buy back 75,000 shares. Now what this essentially means is the dilutive impact of all of this. We issued 100,000 shares, we bought back 75,000 at the average price, so the step 4 is going to be to take this figure less this figure and say, okay, 100,000 minus 75,000, and we get a dilutive impact of 25,000 shares. Now there is another way of doing it. This is the method that's set out in the accounting standards, but there is another method of actually looking at this. And what you can do is say, well look, actually I'm buying shares for $15 when actually they're worth $20. So as a percentage, essentially, I'm paying 75% of market value. 15 divided by 20, 75%. So I'm paying 75%. Now what they're then saying is that's like issuing 75% of these shares at full price and 25% of those shares for free. And of course, if we take 100,000 options times the free element that we just worked out to be 25%, that jumps us straight to the 25,000. If you want to use that approach, that's absolutely fine. Other than that, you can use the step-by-step approach that we've run through. So step 4, to calculate the increase in common stock, we issued 100,000 shares. We could buy back 75,000 shares at the full average price in the year, and therefore the dilutive element is the 25,000 shares issued essentially for free. So our diluted EPS, no impact on the numerator, but notice the increase on the denominator is the 25,000 shares that were issued for free, bringing our EPS down to 229. Let's turn our attention to our next learning outcome statement that asks us to convert the income statement to a common size statement, in fact a vertical common size statement. What is a common size statement? Well, a common size statement means every item in the income statement is being shown as a percentage of your net sales figure. In other words, sales would automatically be 100% because it would be sales divided by sales. Cost of goods sold would be cost of goods sold divided by sales. Sales general admin divided by sales. So you're seeing everything as a percentage of sales. Now this has the ability to convert the income statement from absolute terms to relative percentages. In other words, our income statement presented in the accounts is produced in monetary values, absolute terms. Major problem with that is it's very difficult to compare entities of differing sizes. By converting into percentages, we're eliminating that problem. We're now able to compare firms of differing sizes. So certainly useful for comparing entities of differing size, but also useful comparing the percentages that we're witnessing to the strategies given in management discussion and analysis. So for example, if you read in management discussion and analysis that they had a strong focus on cost control during the year, and yet when you calculate the common size statements, you see sales general and admin as a percentage of sales has increased, you might start questioning what you're reading in the MD&A. Now again, we can use this time series. Now time series would be looking at one company and looking how the percentages change over time, or we can look cross-sectionally. In other words, compare our percentages to other companies at a single point in time. Now by default, two items that we see on the face of an income statement, the gross profit margin and the net profit margin, automatically are common size ratios. The gross profit margin for a company, which of course is gross profit divided by sales, and net profit margin, which is net income divided by sales, are all already common size ratios. So here is a common size statement. The LOS asks us to evaluate performance using common size income statements. Notice our revenue figure, our sales figure, it's always going to be 100% because it's sales divided by sales. But we now can see our cost of goods sold is 48%. Now it means 48% of the value of our sales figure. And therefore our gross profit margin is 52%. Is this good? Is this bad? Well, again, we either need to do time series analysis, look at how that cost of goods sold is changing. Was it a smaller percentage in prior years? Was it a bigger percentage? Is it getting bigger, smaller? Or we might want to compare cross-sectionally. What do our competitors' cost of goods sold look like as a percentage of their sales? Okay, and you can see we've done the same for sales general admin, financing costs, unusual or infrequent items. That gives us our income before tax. You do the same for the provision for income tax. So tax expense divided by sales, 8%. And we've also got a loss here from discontinued operations. So remember, that's the operating results of divisions that have been terminated either during the year or we've made the decision to terminate, of 3%. Now again, looking at the figures in isolation, impossible to evaluate. You need some form of benchmark, either the time series, comparing how these numbers are changing over time, or of course the cross-sectional, benchmarking to competitors. Now, our last little LOS for this particular area relates to comprehensive income. And we're asked here to describe the items, calculate and interpret. Okay, so we need to be aware of the items contained within comprehensive income. Now with comprehensive income, remember it's looking at all of the gains and losses that have been generated from the shareholders, the revenues, the expenses, the gains and losses, no matter where they appear in the financial statements, whether they appear in the income statement or whether they've been taken directly into stockholders' equity. So our starting point is to start with net income. So there it is, our net income, there's our starting point. But then we've got to look at the other comprehensive income items. And these are, remember, these other comprehensive income items are going to be found within our stockholders' equity. So two places we can look for them. You can either look for them in stockholders' equity, but the best place to look at is the reconciliation of opening and closing stockholders' equity. Now you've got to be careful. Remember, the balance sheet shows cumulative figures. It builds year on year. What we want here is this year's gain or loss in each of these comprehensive income items. So what we're going to need to do is look at the change. In other words, look at the closing amount minus the opening amount. Okay, now again, that's why I said look at the reconciliation of opening and closing stockholders' equity, because you'll see the changes there. Okay. So what have we got? We need to be aware of what these are. Now, it's a little bit of a tricky area of the syllabus here, because whilst we need to know what they are, we don't actually cover a lot of this until we hit the level 2 syllabus. So be aware, identify what they are, learn the names if you want, but you don't need to worry about actually what's causing these. I say that, there is one exception to that rule, and it's the unrealized gains and losses on available for sale securities. We are expected to know how that is generated at level 1, and we'll see it in a later reading. Okay, so let's have a look. The change in foreign currency translation adjustments. All you really need to know is this is something to do with conversion of overseas subsidiaries back to our reporting currency at the balance sheet date. Okay, it's caused by using a method called the all current rate method. So in other words, the foreign currency translation adjustment is sometimes referred to as the cumulative translation adjustment, is, if you like, an exchange rate gain or loss caused by converting overseas subsidiaries. Now again, the cumulative translation adjustment in stockholders' equity will be the year-end balance. We don't want that. We want the change in this item. Okay, so a closing minus opening. We'll also need to pick up on pension remeasurements. Now again, we need to be a little bit careful on this. Again, we're not going to really understand these until we get to the level 2 syllabus. It's to do with defined benefit pension accounting, one of the trickier areas of level 2. We'll touch on defined benefit pension accounting at level 1, but it's not really until level 2 that we delve into the mechanics of what is actually driving it. So just be aware, it's something to do with defined benefit pensions. Unrealized gains and losses on derivative contracts accounting for as hedges. Well, this is where you're hedging either the purchase or sale of an item. Now, the idea is you're hedging it using a derivative. So you hold your derivative essentially in the balance sheet, and any unrealized gain or loss is taken directly into stockholders' equity. When then you purchase or sell the asset, let's say, you then release the unrealized gain or loss from comprehensive income into the income statement to match against the gain or loss on the asset. So in other words, we're hedging essentially here. Again, I think all you need to do at level 1 is be aware it's something to do with derivatives held for hedging purposes. Now, unrealized gains and losses on available for sale securities. These we do touch on in the level 1 syllabus. These are passively held investments. We're going to see later on there are 3 classifications for passive investments: held to maturity, available for sale, and trading securities. Now, available for sale securities, the accounting rules say record these instruments at fair value at the balance sheet date. Now, what that means, of course, is as fair value fluctuates, we're going to generate unrealized gains and losses. An unrealized gain or loss simply means a gain or loss that's been generated caused by the fluctuation of market value on a security that has not been sold at the year end. So we're going to have to increase the asset to its fair value, and the other side of the double entry, let's say the asset value's gone up, so we've got an unrealized gain. Rather than taking it to the income statement, it's taken directly into other comprehensive income within stockholders' equity. So these are the unrealized gains and losses on available for sale securities. Again, when you look at stockholders' equity itself, you're seeing the cumulative amount. We don't want the cumulative amount here. We want this year's unrealized gain or loss, which is going to be the difference between this year's balance sheet figure and last year's balance sheet figure. Okay, so once we've got our net income and the changes in all these other comprehensive income items, all we need to do is total it up to get our comprehensive income.